All right, joining us on a very special edition on the India Development Debate Direct for a candid conversation is none other than the Director of NIPFP and, of course, a member of the Prime Minister's Economic Advisory Council, Dr. Rathin Roy. Thanks very much, Dr. Roy, for being with us. It's a pleasure chatting with you right here on ET Now. Much has happened after the government has announced some of the policy prescriptions to arrest the rupee and rein in the CAD. I think it's only fair that we begin talking to you about a threat that looms large over the world, and that's a threat of a global trade war. The US president has escalated the trade war with China, imposing a 10% increase in tariff on goods worth $200 billion. This has been followed up by tariffs on a $50 billion thing. It's now $200 billion. Does China have any choice but to retaliate? At least that's what people in China have been quoted to say. And how does this vitiate the atmosphere of negotiations?
The current trade war is not a global trade war. It is a trade war between two of the biggest economies in the world who have a dispute regarding what is fair and what is unfair in their trade patterns. So it is the United States contention, or the administration's contention, that the Chinese balance of payments, current account surplus with the US is a result of an asymmetric arrangement where US ability to export to China is inhibited, and while the Chinese ability is not, and therefore they want to impose tariffs. And it is their contention that until the balance of trade imbalance between the two countries reduces, they will continue to use tariffs. The Chinese contention is twofold. One is that this is a matter of productivity and not of asymmetry, and the second is that they could well retaliate by using tariffs and are prepared to ride out the inevitable sort of cost push pressures that will arise in the US as a consequence of making imports from China more expensive. That's the situation.
But Dr. Roy, where does this end? And where does this leave the world? I understand you're right in saying that there are two global trade powers engaged in this right now, US and China on one hand. Is this not bound to spill over?
Yes, of course, there are many possible spillovers. One in the short run will inevitably be, as we are seeing, that the US will see a temporary rise in its growth, partly fueled by expectations that there will be opportunities that were hitherto non-existent for US companies to become competitive against many Chinese imports, including especially intermediates and capital goods. And that growth effect is spilling out. That results in a strengthening of the US dollar, and that results in the kind of contagion you're seeing across emerging markets, where seeing this current rise in US prosperity, financial players, alter the algorithms to invest more in the US and less in the rest of the world. That is one. The larger issue here is whether a trade war between the two largest economies in the world will cause the entire basically accepted principle of multilateral negotiation under WTO to come under threat. And if that happens, we live in a very, very different world from the one we are in now. The progress we have made towards free market outcomes in global trade will have been nullified, and each country will then have to start looking far more seriously at the closed economy possibilities to be able to tide over this crisis, as indeed, India is being forced to do when we speak about accentuating import substitution more and looking very hard at the composition of imports.
The finance minister, when he did that press conference on those 4 points, 5 points, very clearly said that one of the reasons why the rupee has depreciated in a more volatile way is the US-China trade tension. What does this do to us both on the trade front as well as the currency front?
Well, on the trade front, it means that when you have one has to examine whether this would result in a widening of the current account deficit to a greater extent that would have happened if this US strengthening of the economy had not happened. And there I do not think there is much cause for concern. Other than the fact that the algorithms of financial players have changed and more financial flows are going to the US, I do not see this impacting either how expensive our imports are or how competitive our exports are vis-a-vis the US. With China, it might in fact have a salutary effect, because if China, if there happens to be a trade war between the US and China, it's quite possible that one of the things that the Chinese will do is try and encourage better trade relations with other partners, including India, by perhaps sort of actively cooperating with us to moderate our huge balance of trade deficit with China. And if that does happen, that's a good thing. On the rupee, on the exchange rate front, it is indubitable that if the US economy grows at levels at which one would expect emerging economies to grow, then the consequence of that will inevitably be a stronger dollar. If there is a stronger dollar, it's not all rosy for the US. There are many things that will happen. Remember that a stronger dollar may also result in inflationary pressures happening in the US, and if that happens, then there'll be interest rate movements in the US which will negatively impact India and other countries, upward interest rate movements. But in the long run, they will have to deal with their inflation. They will have to deal with inflationary pressures. The question is, when will that long run happen? And there, I think global thinking is that this attempt by President Trump to artificially push an economy above its sustainable growth point will fail, because the growth point is not sustainable. President Trump and his economic advisors, such as there are, seem to disagree.
No, but Dr. Roy, you've made a very poignant point in your writings and in your thoughts as far as the reining in of the rupee or the curbing of the CAD is concerned, and you believe that the CAD is wide due to structural problems, and the rupee has depreciated a lot more due to external factors. Now, given those two arguments and given those two contentions, have a lot of efforts over the weekend as far as policy is concerned then been made in vain?
Not at all. I think that I really do not think that policy could have been better formulated. What have we done? Essentially, what India has signaled, I think, to the rest of the world is two things. One, that we are prepared and able to consider short-term measures, such as the 4 measures announced that the RBI and the government will introduce in concert, that people were speculating, in this sort of will he or won't he fashion, that will India, sort of look for NRI inflows, will India sort of open up, financial markets more to foreign investors. And what we have signaled is we are willing to look at all these options should the circumstances arise. We have also signaled very clearly, I think, that as far as the central bank is concerned and our reserves are concerned, those will be used only to dampen any volatility of the rupee, which may happen for structural factors, but more importantly might happen if speculators use this situation to short the rupee. And the fact that the rupee has depreciated but has not been volatile in its depreciation, that's very important. Depreciated but not been volatile in the path of its depreciation means that immediate challenge has been dealt with. Now, as the rupee depreciates, we begin to understand that it is depreciating for external reasons. An important reason is the events we were just discussing with respect to the US economy, and the other is the rise in oil prices. In the case of the rise in oil prices, in a perfect world we would do nothing, but we do know something about this which makes it not a perfect world, which is that Indian oil imports are highly inelastic to price changes. I calculate the price elasticity to be negative 0.24, which means for every $1 rise in oil prices, demand only falls by 24 cents. In those circumstances, we will have to moderate our consumption of goods and services that we buy from abroad. The question is, what do we moderate? And it is in that context that what we are doing is taking, as I see it, is taking a good hard look at the composition of our imports, the consequences of moderating imports either through tariffs or through discouraging consumption other ways. I don't think ever through non-tariff barriers, but there are a variety of instruments by which you can moderate and discourage imports in an 18 to 24 month time frame, such as that has a moderating effect on the CAD. In the case of exports, I'm afraid it's a bit like what Gandhi said about Western civilization. It is always a good idea. It would be a very good idea if India could increase its exports. However, export growth has been sluggish, and what we know is that export growth at least in the current band of the rupee does not respond elastically to price depreciation either, which means 1% increase, depreciation does not result in a 1% increase in our exports. Otherwise, we wouldn't have a problem, right? So, absent that, we must accept that the reason why our exports are sluggish is either the pattern of our growth, there's something wrong, or exports respond to things like world demand and competitiveness, and those we will have to fix. But that is true of the efficiency of Indian production anyway. It's a larger cause. So, per force, the focus will have to be at this moment on moderating imports if keeping the CAD deficit at a moderate level is our objective.
Yes. But how would you refute the argument that a lot of, economists are making, which is that this is a very inelegant way of doing trade. This isn't an elegant way of doing trade. You can't espouse globalization on one platform and then start looking inwards on the other. This is almost a change in the policy that we've adhered to for some decades now. We are talking about our own protectionist stance, and then we want to preach the world globalization. Is there a double speak of sorts at all?
We have a structural current account deficit because our growth is not export-led. Unlike China, unlike South Korea, in the past, our growth is not export-led. Our growth is not coming by producing things for richer consumers in the rest of the world at cheaper prices. Our growth is coming from meeting demand of Indian consumers. It is Indian consumer-driven, home market demand-driven growth. In those circumstances, it is inevitable that you will have a balance of payments deficit. A current account deficit. Now, the question is, what level of current account deficit can you finance? So, the short-term strategy for India has been to say that domestic growth is a good place for foreign investors to invest in, come and invest in India, and we will use those inward flows of foreign savings to finance our current account deficit and deliver growth. But if you begin to see that at the margin, import growth is happening because of growth in consumption, and worse still, growth in consumption not of basic and essential items like food, but of luxuries. I'll give you an example in a second. Then it is time certainly to take stock of the pattern of imports, what we are importing. And it is not to refute globalization to say that we wish to elect a different growth path, in which the consequence of that growth path is not an increase in luxury consumption of imports, in which we are not seeing a 100% increase, close to a 100% increase every year in the import of foreign education, which till 15 years ago used to be non-tradable. That's not an unreasonable thing to say. It doesn't mean I'm going to impose curbs, etc. But I've got to understand what it is that we are importing, and if those are luxuries, we have to come up with a policy to try and moderate the consumption of luxuries. That's a perfectly legitimate aim of economic policy.
Okay. I want to actually move the discussion away from this and talk to you about a fresh concern. The Saudi Arabia today said that $80 to a barrel and above are oil levels that they are comfortable with. How damning is this going to be for India, which is a huge importer of oil? It directly impacts our fiscal deficit. And is it time we review and perhaps rework the fiscal math?
Oil prices are going to rise to $80 a barrel. The key question is this: will that, without intervention, moderate the consumption of petroleum products? Let me give you an example going on that same old way. One of the largest growth sectors in India in the recent past has been civil aviation. If it is a communist thing for me to say, in the minds of some people, that the civil aviation market is not a market that the common man has access to, at least yet, then I have to worry about the fact that civil aviation prices of civil aviation tickets and the growth of the civil aviation industry is not moderating when oil prices rise. And I have to wonder why that does not happen, and I have to take steps to deal with it. So when oil price, the best thing I would want as a market-friendly economist is that consumers respond to supply and demand. So when prices rise, then demand must moderate. If demand is not moderating, then it's not a free market. Things are stacked in a certain way. I need to get to the bottom of that and need to act to make sure that markets comply with the laws of supply and demand. And that is patently not happening in India, and therefore I have to worry. So if oil prices go to $80 or $90 a barrel and that results in a moderating of consumption, by an equiproportional moderating of consumption, then I would say, okay, now we can see whether this moderating of consumption is hurting growth or not. But if consumption is not being moderated and the aviation economy continues to grow at 17% a year, then I have to surely examine what this pattern of consumption means and take moderating measures to do it, because then these particular luxury markets are not following the laws of supply and demand. You did ask me another question, so I'll close with that if I may, which is about the fiscal deficit. And I want to say this very emphatically. I think the FM has said we will stick to the fiscal deficit target. I am completely persuaded that there is nothing happening in the economy at the present time or in the foreseeable future that should force India to deviate from the commitment the finance minister made to keep a fiscal deficit of 3.3% of GDP in his budget speech. The central government fiscal deficit can, will and should be maintained. The finance minister himself has said that he's committed to maintain it, and I really don't see why this ghost keeps coming out about fiscal deficit relaxation when both the authorities and economists like me who know something about public finance are saying that there is neither the case nor cause for us to deviate from our fiscal deficit target. I want to make that very, very clear, because I do not want to see the suits of Bombay doing what they did last year, which is coming in November and again undergoing special pleading for fiscal relaxation on what I regard as macroeconomically damaging grounds and putting pressure on the finance minister to do so.
No, that's a brilliant point that you made on the fiscal deficit, and you're absolutely right. Nobody should be advocating fiscal slippage at all. But at this stage, I think what you say makes a lot of sense, that the finance minister has reiterated his commitment to 3.3%. There are no big fault lines that we will perhaps go away from consolidation. And this government has been remarkably prudent as far as the fisc is concerned. But on that note, Dr. Rathin Roy, thank you very, very much for joining us on this edition of the India Development Debate. We look forward to seeing a lot more of you right here on ET Now. So thank you very much for being with us.
Thank you for inviting me.